I once met a commercial property investor who lost everything because they were underinsured. And while that story hit home as an investor myself, I also know it's not unique. It happens more than you'd think, and it could happen to you. It also made me realize how many people don't really get commercial property insurance, and that it is quite a bit more nuanced than standard resi insurance. And look, I know insurance isn't the most exciting topic, but trust me, it's something you need to understand if you're in the commercial property game. So I want to talk about the real costs of insuring different types of commercial properties. We'll look at both industrial and retail spaces, and I'll show you what affects the price. I've run the numbers on properties ranging from $700,000 to $3 million. And I've figured out the 5 main things that can make or break your insurance coverage. So let's get into it. Here's what you need to know about commercial property insurance in Australia and why it matters more than you think. Let's dive into the first key point: what commercial property insurance actually covers. There are 3 main things. First, it protects your physical assets. This includes the building if you own it, plus everything inside like equipment and inventory. Second, it provides business interruption coverage. If you can't operate due to a covered event, this replaces your lost income. Third, it includes liability protection. This covers you if someone gets injured on your property or claims your product harmed them. The key differences between commercial and residential insurance is the scale. Commercial policies have higher limits because the businesses typically have more valuable assets. They also include business interruption coverage, which home policies don't. Now, let's talk about how different property types can affect your insurance. There are 2 main types of commercial properties: strata managed and freehold. Strata managed properties are part of a larger complex. If you own one of these, your insurance needs are simpler. You're only responsible for what's inside your space. The standard cover includes business property, but just for the contents, business interruption for 12 months, and public and product liability of up to 10 million. Freehold properties are standalone buildings. If you own one of these, you're responsible for insuring everything. The standard cover here is more comprehensive. You've got business property for both the building and the contents, business interruption for up to 24 months, and public and product liability for up to 10 million. The main difference is in what you're responsible for. With a strata managed property, you don't need to worry about insuring the building itself, but you do need to check that the body corporate holds adequate insurance for the building. With a freehold property, you do. Also, you might have noticed a difference in business interruption coverage. Freehold properties get 24 months of coverage instead of 12. This is because if something happens to a standalone building, it often takes longer to get back into business. Let's break down what actually affects your insurance costs. Now, let me just mention that there are so many factors that need to be considered, which will change the outcome of the premium. But for the purpose of this video and the comparative analysis I'm going to do in the next section, these are the 5 factors that influenced our clients' insurance premiums. First, the age of the building. Generally, newer buildings cost less to insure because they're built to modern standards and they're less likely to have issues. Second, construction materials. Fire-resistant materials like concrete or steel typically result in lower premiums compared to more flammable materials. Third, fire protection. Having measures like fire blankets and extinguishers can significantly reduce your costs. It shows insurers you're serious about preventing damage. Fourth, security features. Things like deadlocks on doors and good external lighting matter. They reduce the risk of break-ins and vandalism. And fifth, this is one that's often overlooked, the type of tenant. Different businesses carry different types of risks. Some types of businesses are considered higher risk than others due to the nature of their operations. For example, a cafe with deep fries is considered a higher risk than, say, a clothing shop. I personally own a laundromat and I have to pay a higher premium due to that because of all the equipment in the shop. Depending on the property, I would also recommend machinery breakdown cover for things like aircon units, cold rooms, and roller doors. Now, for comparative purposes, let's look at how these factors influence your annual premiums. We'll use a property built in 2000 with concrete floors and walls, a steel roof, standard fire protection, and security features. First, let's compare a body corp industrial property to a body corp retail property, both valued at $2 million. The body corp industrial property with a motor mechanic tenant has an annual premium of $2,012. This covers $100K in contents, 12 months of business interruption, and 10 mil in public liability. Here we have a body corp retail property with a cafe tenant which has an annual premium of $3,218. It has the exact same coverage limits, but the premium is about 60% higher. Now, let's look at freestanding properties valued at $1 million. The freestanding industrial property, again with a motor mechanic tenant, has an annual premium of $4,600. This covers $75,000 in contents, 24 months of business interruption, 10 mil in public liability, and $800,000 in building insurance. The freestanding retail property with a cafe tenant jumps to an annual premium of $8,300. That's for the same coverage limits, but premium is 80% higher. Here we have a few more examples to compare freestanding versus body corporate buildings at different values. Again, you can see that retail properties, especially those with high-risk tenants like restaurants, have much higher premiums than industrial properties of the same value. Freestanding properties have significantly higher premiums than body corporate properties because you're insuring the entire building, not just the contents. Hopefully now that you've actually seen some quotes and how much they differ based on the type of property and even the type of tenant, you can actually use this information when it comes to deciding what type of commercial property to invest in. Because a $20,000 insurance premium versus a $10,000 premium will ultimately affect your ROI. I guess the point I'm trying to make is that insurance is definitely more of a strategic decision in commercial compared with residential, and something that you just ensure you're doing the right due diligence on. I actually did a due diligence breakdown video with one of my clients who bought a cafe in Perth. It's quite a helpful overview of what to look out for, so go check it out. Either way, I'll see you in the next video, guys.